Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to Peter Harris, Exec Chairman of Northbridge Industrial Services, a specialist equipment hire and sales group. So welcome, Peter.
Hi, Paul. Nice to be with you again.
Yeah, well, massive congrats on this morning's excellent first half results with sales up 22% to £19.6 million, which I think actually is a record for Northbridge. And adjusted EBITDA coming in at £4 million, up 27% like for like. But before we sort of dig into those details, I suppose you could quickly remind investors of what Northbridge does and what's been, frankly, driving the phenomenal top-line growth.
Yeah, I'll happily do that. Northbridge has two principal divisions. I'll talk about the smaller one first, which is Tasmin. Tasmin rents tools out into the gas, oil, geothermal markets, primarily in the Far East, Middle East, and Asia Pac. And that's a division that struggled a little bit in recent years after the oil price fall about 7 or 8 years ago. The market has been difficult, and that's passed through to suppliers into the market like ourselves. And last year, we moved it back into profit at the start of the year. And then, of course, the pandemic came. How long into any interview is it before you mention COVID? And it really struggled in the middle quarters of last year. We were expecting and hoping to see a gradual recovery from this year. Frankly, the pandemic's affected us in that division longer than we originally expected. It's still quite difficult to get equipment and operators in particular out to rigs because of the travel restrictions. So it's not had a bad half year, Tasmin. It struggled along, made a small loss. And in fact, actually has performed very resiliently in the face of a fairly quiet market. The good news on Tasmin is we are starting to see contracts coming through for next year now. So that recovery we're expecting to see looks as though it's going to happen, but just 6 to 9 months later than we hoped.
Particularly on the gas price, presumably, because it's more focused to LNG, isn't it?
Yeah, it is. I mean, the vast majority of our rental goes into the gas market, and obviously people are crying out for gas all over the place at the moment. It's amazing how the situation changes. Practically negative gas prices a year ago in Australia. They were struggling to get people to take the production. Well, and now China's knocking on the door all the time saying, give us more, give us more. And we know the situation in this country. So, that will undoubtedly prompt more exploration drilling over time, and that will undoubtedly feed back through to our business. Take a little while, but it's a positive thing for us.
What sort of like springs out to investors here, just was the revenues went down for Tasmin by 25%, but it was actually only a very small loss, which means just by doing the maths, because I actually was a mathematician in my early days, it means that if the revenues went up by 22%, the crown jewel, Crestchic, must have had an absolute blockbuster first half, and that's where the records come. I think when I look at it, you're up 20% on 2019 levels. So you must have really had a very good, strong Crestchic.
Yeah, it was a huge performance. Let's just close out Tasmin before I go to Crestchic, because I mean everyone knows that Tasmin is probably going to be sold. We've actually progressed that situation, given quite a lot of detail about it in the announcement today. What we've found is that it's going to be easier to sell it in pieces rather than together. We have what looks like a fairly firm offer for the Australia and New Zealand businesses, which we're progressing and hope to complete in the next couple of months. We're exiting the loss-making joint venture in Malaysia, and we've got a conditional offer for the Middle East business as well, which is a lot further away from being completed, but at least gives some visibility in that direction. So we're still hopeful of a successful exit from that business, albeit at a discount to net assets, but it'll generate enough cash to leave us debt-free pretty much by year end. Yeah. And instead of a drain on profits this year, it'll be won't be there next year. If we do have to retain Australia and New Zealand for a while, they are good businesses, as I mentioned earlier. Having restructured the joint venture in Malaysia, the division should be profitable next year. So we're comfortable with either option, but strategically, we'd prefer to exit Tasmin so that we can focus all our energy on Crestchic. Why do we want to do that? Well, you've already given me the introduction. It had a stonking half year. As we said in the announcement, that momentum's continuing through H2 and already pulling into 2022. What's driving that? Well, we sell into 5 market sectors. We've got 3 quite traditional market sectors that we've been in for a long time. The marine sector, where most ships nowadays are electric ships. The generators that drive them need commissioning and testing, and they serve all sorts of different marine applications in terms of what they carry. Quite a lot of it actually is also related to oil and gas, but lots of container ships, etc. So that has been good for us. We have extractive industries, so principally mining and to some extent gas and a little bit of oil, where mines and wells need power and auxiliary power supplies. A lot of them are in pretty inhospitable regions, so they're not driven off grids. They're driven by massive generators, again, need commissioning and testing.
Data centers, vibrant.
Well, you want me to move straight onto the high growth areas and leave the rest of them, I'm sure I'll happily do that. The 2 high growth areas we have, data centers have just done terrifically well for us, really over the last 3 to 4 years. Everyone knows that the economy is increasingly data driven, and everyone knows that whatever's said has to be recorded and stored somewhere. So data centers are growing massively around the world, and actually got accelerated further by the pandemic, because just as we're doing this interview remotely by Zoom at the moment, a couple of years back, we wouldn't have dreamt of doing that. Would have been face to face across a desk with a camera. So people are using their systems a lot more to do things that previously were done by physical travel. And that's been very good for us, and data centers has continued to grow. As our presence in the sector has grown, we're also getting to be more direct in our sales. And one of the things we're really, really pleased to announce in the results, that we'd flagged it previously in a trading update, is we have received our first direct order from one of the major e-commerce retailers. So rather than going through an intermediary, we've got to them direct because we've got their attention now. Why do they come to us direct? Well, I think they know that we have the global presence, we have the technology, we have the support to absolutely guarantee that critical infrastructure is in safe hands. So that's really, really encouraging. And the other area that continues to do very well for us, grid resilience, and particularly the onset of renewables. We're all driven by electric power, and increasingly with the concern on the environment and COP26 around the corner, a lot more of that power is coming from renewable sources, be that wind, be that wave, be that water, hydro. And that presents its own challenges to the grids, because you have to interface these more variable and unpredictable supplies into the grids. So actually the sources themselves, be they battery farms, be they wind turbines, they need commissioning and testing. And then the interface into the grid needs commissioning and testing. And that's giving us lots of opportunities and leading to us to slightly reprofile the fleet in some cases, because we need slightly different technology in the grid, in the load banks to test renewables. And we need different technology, again, DC load banks to test battery farms, which is really good for us.
I saw on the actual in the statement this morning that for the data centers, you're also doing server emulators. Can you just tell people what that is?
Yeah, well, what do we do for a data center? It's all very well say data centers are growing like mad. Well, data centers actually consume quite a lot of power because they store the product on servers, which need powering up. Those servers generate a lot of heat. So you actually have to cool down the data center that's got all the servers within it. So firstly, you need to commission the actual data center itself and check that all its systems are intact, check that the cooling will actually do the job for the environment. And then secondly, you have to just test that in operation, this data center is going to function. So we will test the backup generators, we'll test the interfaces inside the data center, and then we mimic the heat pattern that's generated by the servers to test the cooling systems.
Yeah, okay.
And you can do that in two ways. You can either use conventional load banks and have a small number of small to medium-sized load banks positioned along the data center pumping out heat. Or you can do it more precisely by using what we call server emulators, it's an industry standard term. And these are basically mini load banks that are the exact size and shape of a server and generate the same heat pattern as a server. And you just rack them up in the racks that are going to contain the servers. And then you've got a very precise heat pattern to test the infrastructure of the data center against. Downsides of server emulators, as you can imagine, it's quite labor intensive, racking them up, cabling them up, and then taking them all down again. It's a market that we hadn't played in until recently because of those characteristics, but it's quite a strong market. And we've found there is an emerging market for slightly value-added versions of the server emulators that have more sophisticated control systems and a broader range of testing applications. And that starts playing to our strengths because our strengths are, design, innovation, technology. So we've had a trial fleet of reasonably well-spec'd server emulators that we bought in and we're running. And we're actually doing development work in conjunction with our clients to identify how we could design and build a better mousetrap, basically. And so it's a market we expect to enter, not in the commoditized end of it, but in the higher end of it.
Right. And then you also talked about the larger projects coming back for Crestchic as well, which had seen that in Q2 and then has carried on into Q3. Can you just give us a quick example of what you mean by that? Is that a mining project or is that sort of like an infrastructure like HS2 or?
The really large ones tend to be infrastructure projects, but quite discrete infrastructure projects, not something like HS2. HS2 we do work for, but there tend to be lots of sites on HS2 because it's huge. It's a Western place, so there are lots of places where you need testing work. But if somebody's putting in a new power station, that will need a significant amount of commissioning and testing. And that's the sort of test where you'll need. I mean, our very largest load banks tend to be about 5 megawatts. We have got one or two that are slightly larger than that, but that's a pretty large and meaty load bank, and it will handle a lot of tests individually. The very large sites, be that a massive mine, be that a power station, in some cases it could be just some sort of systems to supply a new retail center, for instance. Right. That could be taking 50, 60 megawatts in one go and be running it for quite a sustained period of time because it's a complete new startup. They'll book our equipment for a certain period of time, but there's an expectation on both sides of the table that it'll probably extend because the testing will reveal issues. They'll have to rectify them. They'll have to retest. And obviously, with something of that scale, both in terms of the sheer amount of equipment it commits, the types of location you have to get it to, and the length of the testing, they generate a lot of money.
Yeah.
And I don't think we ever have a year without any of these, but they are the sort of icing on the cake projects that if you have a year that has 7 or 8 of them, it's noticeably different outcome than a year that has 2 or 3. So if you watch Crestchic results as an individual division, I think it'd be fair to say that we're steadily moving upwards, but it is a slight oscillating wave according to how many of the large projects are about. And last year they did almost go away in H2 because, again, COVID, you couldn't get the equipment out, you couldn't get the people to site. So much as there was demand to have the projects, they just physically couldn't be done. And we said all along that we weren't seeing these projects being cancelled. We were hopeful that they were just being pushed back. And I think that's what we're seeing now. They're coming through this year. Started off actually very well in Q1. We had a couple of big tests out in China. And then it's fed through to the rest of the world and has continued to feed through over the rest of the year so far.
So you've seen that sort of the Far East and then moving out into sort of like the States, the UK, and then finally, how's Europe? Because that was last time I think we chatted was the slower region, but that's presumably coming back as well. That will come back later.
It is. Germany's having a really good year. The UK is having a really good year. Europe's one of the areas of huge opportunity for us. Partly because it's near at hand, but partly because it's got very developed infrastructure, so it actually knows how to use our equipment and how to optimize things by using sophisticated equipment. And we've got a transformers business that's been a bit too quiet for the last few years. So what we've done is we've hired in a new rental manager or rental director for the whole of our Western European business, and he's putting some real energy behind it. Germany's already back up to speed and doing very, very well. Transformers business is going to be looking to start growing again very shortly. We've got markets like France where we've made a very successful entry, but the market size should be somewhere between the UK and Germany, and our presence there is nothing like that size. So here we've got real opportunities. Europe's doing well for us. It's grown year on year, but there's a lot more headroom there. And then, the other geography we're very keen on is the USA. Sorry?
Good. That's what I thought you were going to say.
Yeah. It's the answer you wanted to hear, isn't it? So with the USA, we made a very successful and careful entry into about 10 years ago. And we've steadily built our presence there, taken no stupid risks. And we do very well on three fronts, really. We have a rental depot in Pennsylvania, which does well. We have a sales agent in California, who we've had for many years, who does a cracking job for us on the west coast of the USA. Then we have our own small direct sales force that sells to the rest of the USA. What's holding us back at the moment? Two things. On the rental side, just equipment availability. Our factory is absolutely rammed at the moment, and we're in the process of building a huge extension to it, which will solve that problem. But it's an issue. But also on the rental side, there's issues of technical specification. The US market is slightly different to the European market. And for some of the areas that are really good for us in many areas of the world, like data centers, you need a slightly different product specification than we have. And you also need to be a bit closer to the customers. A lot of the customers are actually down in the Texas area for data centers. We're in Pennsylvania. It's just too far, frankly. You say it's the same country. It's not the same as going from Burton-on-Trent to London. The distances are huge.
Yeah.
So Texas depot is where we're heading next year. We're looking for sites at the moment, and we'll commission that as soon as we know the factory is ready to produce the additional equipment we need for the hire fleet. And then on the sales side, the constraint primarily is around lead times. For somebody to order one of our products, for us to tailor it to US spec, build it, ship it to the USA, it's just a fairly extended lead time. We're on quite long lead times anyway, because we're a build to order operation. And the Americans are not noted for their patience when it comes to they want something, they want it. Quite right too.
Yeah.
So we want to actually have some almost complete stock in the USA, which can just be configured to final customer specifications by the engineering staff we now have there. But again, until we've got factory capacity, we can't put that seed stock in place. So USA is doing well for us this year. It will be up year on year, despite having had a stellar year last year. Opportunity is quite significant there.
Well, I would certainly say if President Biden gets his way and manages to twist Congress's arm, you're going to see an absolutely enormous infrastructure bill coming through the Senate and the House. So that'll definitely. What's the sort of timings in terms of turning on the extra capacity at the new or the extended factory in Buxton?
Burton, it's getting closer. We got planning permission, as you know, towards the back end of the first half. As ever, it came with some planning conditions. They weren't actually ridiculously onerous. They were quite sensible, but they're just things like, Burton's got a Roman road running through it, so you have to check your site to make sure you're not going to be digging up a Roman villa when you're building the foundation. So it all takes a sort of month or so, but we knew that would happen. But we actually broke ground about a month ago. The site's very busy at the moment. It's all been leveled. We've broken through for putting the electrics in, about to start digging foundations. Concrete's going to be poured very shortly for foundations. That'll be within the next couple of weeks. And then the walls will start going up. So at the moment, it looks as though we've gone backwards.
Right, okay, yeah.
We just cleared the site and it's all glorious and level, but no, it's going. All the materials have been bought in ahead and contracted, so we're not going to suffer materials price escalation.
Good.
And we're still looking at a commissioning date sometime in Q2 next year. I think it'd be rash to say too exactly when that will be, because you know what's going on at the moment. Sometimes your concrete lorry might not turn up one day because it can't get petrol. I mean, it's a funny world we're dealing with, but at the moment we're on schedule, on budget, and And end of Q2 would be very difficult to see it being later than that. If we can humanly get it earlier, that'd be fantastic.
And how's the business actually managing the supply chain disruption on the sort of the load bank side? Because I noticed you're storing more inventory than you normally do, and that was deliberate. And likewise, you're pushing any cost inflation through pricing.
Yeah, I mean, we manage it intensively, I think would be the right description, because it's a really important issue for us at the best of times, as it is with many businesses, many manufacturing businesses. But at the moment, with the challenges presented by the sort of lingering hangover from the pandemic and now fuel disruption, etc., it's a more difficult challenge. So we work very, very closely with our suppliers. And actually, because of the good relationships, if they can't supply us, they tend to tell us good and early. And then we have a degree of capability to manage our production scheduling and move from one job to the next. So if fans don't turn up and we've got 10 load banks that are waiting for fans, there's probably another 10 in somewhere else in the factory which either don't need fans just yet or already have the fans and need some other work. And though there's a degree of inefficiency in that, we can switch the engineering technicians around from one job to the next to some extent. We have had to investigate alternative suppliers for some products. That sounds easy. It's not easy. Our products are pretty high spec. And when we're buying components in, they have to be ruthlessly and remorselessly tested. So switching suppliers is easier in practice than in principle, but we have achieved it for some of the key supplies. And then when stuff's on the water, we stay very close to it. And if we find that it's actually got stuck quayside somewhere, we move heaven and earth to get it onto our next ship or whatever. We intervene directly into the shipment process. So challenging, and it's definitely had some consequences, but don't think we could have handled it any better than we actually did. And coming back, yeah, we are seeing price increases. Again, we're managing them. We don't get caught by surprise by them because we're quite long lead time. So when a price increase comes through, we can generally factor it into future sales, and we're not caught. We've already contracted the major components for the existing order pipeline. I think we've got good relationships with our customers. They know we don't impose price increases on them unless we have to. We're quite reluctant to be honest. So we haven't had any undue kickback when we've gone to them. We've gone to them good and early and said, look, this is coming down the wire. We've got an opportunity. We always have an opportunity to push a price increase back if we can get an order brought forward slightly. And if they're not prepared to do that, people accept and say, no, sorry, we'll just take it when it comes. And we haven't put huge, stonking great price increases through. There have been very much tactical pricing increases to address individual problems. I would say that though we're still seeing materials price escalation, our focus is a little bit moving now onto wage and salary inflation because we think that's coming down the wire. Anyone who reads UK economic news is seeing labour shortages, skilled labour shortages all over the place. And you can throw labels around that it's Brexit or whatever. I mean, frankly, we don't really mind what's causing it. We're just looking for solutions, and we're recognising that probably we've got some very valuable staff, and we're going to have to pay them appropriately to keep them. So we'd expect to see that, and we'll build that into pricing as well.
Yeah, I think globally, producer price inflation is going up. It's high single digits, 8-9%. I think most places, not CPI, but producer price inflation. Now, we were talking about pouring concrete into the ground for foundations. Another thing which is pouring out is cash. I noticed in the first 6 months, you generated almost £2 million, or you reduced the net debt by almost £2 million to 3.5 million. And if I just sort of work the maths and sort of like look at what was said in the statements, I sort of like get to sort of 45 million of net proceeds you may or may not get if you go through a successful exit of Tasmin, which puts you into a positive cash position at the year end, if that actually happens in terms of a full sort of exit. And it's sort of like, I noticed yesterday you were sort of like talking about putting dividends in, but can you just talk through that whole process of dividends and the cash generation of the business and where you're looking to invest?
Well, the great beauty of Crestchic in particular is it's an inherently cash generative business. That's one of its great attractions. Apart from the fact it's fantastic product and and it's got good margins. But it is inherently cash generative, and that's something that's really, really important to us. So it's been a big focus really ever since the middle of last year when the pandemic struck. We've really husbanded, we never throw cash around, but we've really husbanded cash very, very tightly. And to be honest, even as some of the pressures of the pandemic eased, we're always just saying, look, we'll believe the pandemic's over when we're finally proved the pandemic's over. We're just going to carry on managing things very, very carefully. And that has resulted in us clawing cash back. We've had a couple of following wins, one of which has been the Tasmin divestment process and the fact that oil and gas has been a bit slower this year than it otherwise would have been. I mean, we'd have naturally just managed our investment levels in Tasmin ahead of a divestment slightly more carefully than we would have. And we haven't compromised it as an ongoing business, but we've just been careful about it. And the fact that the market this year has been a little bit slower has meant we haven't had to invest against contract wins quite as much as we had in the original budget. So that's a following wind. And in Crestchic, to some extent, we've had the constraint of the factory. So we haven't been able to build quite as much equipment for the hire fleet as we would have done. And we've got around that. I think we've mentioned this in earlier interviews by ingeniously scouring the world for used Crestchic equipment that's not actually being utilized by former customers and buying it back, refurbing it if necessary, but sometimes it doesn't even need refurbishing other than a lick of paint, and putting it into the hire fleet. And we've done that with a number of significant units this year. And again, that's saved us building it and saved the cash going out through the factory. So, and then on the other side, we have had to maintain slightly higher inventory levels to cope with supply chain issues. And we're going to continue to do that until things get back to normal. But overall, it's been a really good outcome for cash. And if Tasmin does complete, depending on the cash flows from the deal, and I'm not being obtuse on that, until the deal's done, you don't know what those are going to be in terms of timings. But there should be enough cash coming back from that to discharge the net debt we have on the balance sheet at the moment. Doesn't mean we want to remain ungeared indefinitely. We've got as you know, lots of plans for the development of Crestchic, but it's a great position to start from. And then in terms of the announcement yesterday on the capital restructure, as you know, with the problems in Tasmin, we've ended up with negative retained earnings, despite the fact we're now back in significant profits. And first constraint on that is dividends, so we have to rectify that. The second thing is we do have, we've taken out our options plan for the directors and senior management and replaced it with an LTIP plan, which is share-based. And we actually want to be able to, if that pays out, God willing, we want to be able to fund that without having to issue new shares and diluting shareholders. So we said when we put it in place that we'd try and buy in the shares to fund the LTIP, so there was no dilution. And again, we can't do the share buyback till we go through the capital restructure and eliminate the negative retained earnings. So what we're doing is taking our substantial share premium account and cancelling that against the profit and loss account in glorious accounting terms. You're a mathematician, you'll understand all this stuff. And it doesn't alter the total amount of equity in the business. It just repositions it between distributable and non-distributable reserves. And that frees us up to both pay dividends and execute the share buyback program, both of which we think are value creating for shareholders.
I've done the maths actually, just recut my numbers because I've upgraded my numbers following today's excellent results, and my fair value for the company, this is conservative, has nudged up from 192p per share to £200 per share. Sorry, 200p per share. Not £200, 200p. And I think that is still very, very conservative. So it's obviously on an upwards trajectory, no doubt about it. And can you just talk about sort of news flow going forward? Then we've got obviously the Tasmin sort of like piecemeal disposals, so that news coming, and then anything else on which may or may not happen over the next 3 to 6. You're presumably doing a year-end trading update in January or something like that.
Yeah, we'll do a year-end trading update. We'll possibly do one before that. But in terms of major events, I think the focus is definitely on either completing the Tasmin exit or finishing the keeping Australia and New Zealand, making sure they're profitable, and completing the move on of the other businesses. So that's really important to us, and we will announce that as and when there's complete clarity on what the outcome is of that. Other than that, I mean, if you look at the list of strategic priorities we put out to the market at the end of the first quarter, basically, once the Tasman thing is done, we've actually ticked the list. So we have to make a new list, basically.
I've more to do.
Yeah. So there's then going to be a little period of sort of fairly invisible work, I think, because we are working hard on pushing Europe forward. We are working hard on pushing the USA forward, but the USA is constrained to some extent. There's lots of groundwork we can do, but it won't be terribly visible until we ease the factory production constraints. So the next big real opportunity for us to celebrate will be when we've got the factory up and running, and that'll be huge for us, because it is a 50% plus capacity increase.
Yeah,
and a lot of our plans, but yeah, there'll be very well rehearsed plans by then, because we've got a few months where we can't actually execute them to really make sure they're in place. Most of the key people we wanted to put in place to drive the plans forward are either here or just about to arrive. We've been putting some really good people in place. We've got the guy who's running Europe for us has made an immediate impact. A very credible guy. We've hired a business development manager for the USA. He's already he's only been in place less than a month, and can't imagine life without him already. We're hoping our technical director will be joining us before Christmas. Really can't tell you anything until all the I's are dotted and T's on that. He comes from a company with an absolute pedigree of supply chain management, and in particular engineering, R&D, and innovation. So that's going to be a huge plus for us. So we're putting the people blocks in place. And in terms of trading, I think we'll tell the market when good big things come in, and we've got a very encouraging pipeline of opportunities over and above the actual order backlog that's already there. So we'll keep people posted on how that's developing.
Well, you've certainly whet my appetite. You've got a long runway ahead of potential news flow. And I think investors should take a longer term view on this, because not only we've got large demand or high demand currently, and that's what we put in the capacity increase, but actually going forward, it could well be that you have a whole series of different sort of demand, long-term secular demand drivers that really sort of take that Crestchic business to a totally different level.
I hope so. I mean, as you know, we've got those two quite high growth sectors in data centers and renewables, and the other sectors are all doing well. But the other sectors broadly, we perform in line with the economy, and the other. Well, I suppose all do, but the two out of the 5 sectors are just such good sectors to be in. It's very fortunate for us. We do have geographic opportunities on top of that. So some of the sectors we're doing really well in, we're only doing them well in a small part of the world. And we've got obvious opportunities to increase our footprint or increase our penetration in areas where we're already there. So that's good news. And I think the other thing that we've been very good at, and we're going to put more energy behind, particularly with the new technical director on board, is really getting close to our customers and understanding how our products match up against their needs, what their emerging needs are, how we can tailor our products to meet emerging needs. And that's one of the distinguishing features between us and our competition. We don't just sell this stuff. We don't just hire this stuff. We actually design and make it. So we can be ahead of the game in terms of making sure our product is at the cutting edge of customer needs. And we're seeing that in lots of things. Most of our innovation, unfortunately, is invisible because it's in the control systems inside the box. But we've got more tangible stuff like data centers market, where people really struggle to move load banks around very large sites. And we've produced trailerized trailerized load banks, which have all the cabling on a big reel, can just be driven around the site, and they're hugely helpful. So we'll be doing more of that. We'll be looking for product innovation to drive even further market share and penetration. So lots to do. Lots to do.
Well, as I say, thanks very much, Peter, for the excellent insights, and congrats on the terrific first half results. And if anybody wants to follow Northbridge and get all the news and commentary into their email, just hit the button on the website. So thanks again, Peter. Look forward to touching
thanks,
base.
Paul. Appreciate the support. It's nice to talk to you again.
Thank you.